ahead and try that again. All right. Well, I want to thank everyone for joining us today. My name is Lindsey McKay, and I'm joined by Andrew Lee and Scott Karstens. And we're here today to talk about long-term care insurance primarily. It's a big topic of conversation that we're hearing more and more about from our clients. We're hearing about people that are wondering if it's something that they should have. So first and foremost, we'll talk about really what is long-term care insurance, who should be considering it, and what options are available. But we're also hearing a lot from clients who are saying that they have insurance and they're not sure if they should continue the same coverage that they have, or they have concerns about what does the future for their policies hold, especially as we continue to have an increasing number of premium rate increases and other communications that we're getting from from the companies that hold our policies directly. So our game plan today is to address as much of that generically as possible. So again, high level, sharing information, questions that we're hearing, providing some guidance. But if you have questions about your own circumstances, whether that's exploring long-term care insurance for the first time or revisiting coverage that you might have, I encourage you to reach out to myself, Andrew, or another member of the team, and we can review the policy that you have. Or if you're looking for coverage, kind of help explore options for you. That's really how Scott supports us in the work that we do. He is out there kind of getting the lay of the land, kind of looking at all the different types of insurance that are available. And so when we go to him and we say, hey, here's the circumstances that we have for an individual or a couple and what they're looking for, he helps us find a solution. So we brought him in today as really kind of the expert on the long-term care side. And so we're going to ask him some questions. He's going to give some answers as well as some stories of things that he's seen, experiences that he's aware of, and really just kind of help to drive the conversation as we dive into long-term care. If you have any questions, I encourage you to put them in the question and answer box. Otherwise, as I said, feel free to follow up with any team member. They can help you make sure that we can address questions that are specific to your circumstances. So with that, let's kick it away and start talking about long-term care.
Yeah, so Scott, the first question, apart from being Thanksgiving, I know everyone on the call is excited because November is also Long-Term Care Insurance Awareness Month. So November is a great month, but can we start off by talking about what is long-term care insurance?
Yeah, it's a great question. And I know oftentimes people get confused with long-term care and what they're getting with Medicare, Medicaid, whatever it might be. And first and foremost, long-term care insurance is not actually medical coverage at all. It's actually coverage for things that you do in everyday life that you end up needing assistance with. So you have your Medicare and Medicaid for, what if I have a cancer diagnosis? What if I have some sort of illness for treatment that needs to happen? The long-term care side of things is more assistive care. So if I can't bathe, dress, use the toilet, transfer, if I have incontinence or I can't eat without substantial assistance, there's one thing on there that I think is becoming more and more of an issue is then also memory. So cognitive impairment that requires you to have significant assistance is another one of those triggers as well. So when those things trigger an event, long-term care is a coverage that kicks in to help provide support for the loss of those activities.
One of the things that comes up often with clients is, how do I have an understanding of what my long-term care policy will cover and what it potentially won't cover? How would we go about, obviously, if I have a policy, I can reference my policy, but just generally, what are the things for us to be thinking about?
So if you think of things that you can no longer do, that's generally what long-term care is going to cover. So most people think long-term care is going to happen inside a living facility and somebody else is going to take care of all my medical needs. For many, long-term care does happen in a facility, but for most, over 80% of the care that happens, especially early on in a claim, happens inside the home. So things that tend to fall off pretty fast when you're unable to perform those activities of daily living would be, how do I keep my house clean? I need somebody to help me with my checkbook. I might need someone for a task like remembering to take my medication on time, or not only taking it on time, but not overdosing on their medication. Sometimes we have trouble remembering that I took my medication at this time. Um, then when you get on top of that, preparing meals, shopping, moving around your house isn't on here, but most homes today aren't set up for wheelchair accessibility. Or if I'm unable to move around as well, and now I have a walker or some sort of assistive care helping me move around my house, all of a sudden the cabinets become higher and the countertops get higher, even though they didn't change. Caring for your pets, and so on. It's a pretty long list, but those are some good ideas right there just to help get an idea of what can cause a claim and what can cause expense to you as a result of losing those activities of daily living.
So we covered
One
what
of the things.
Sorry, Lindsey, you go ahead.
Yep, no, my thoughts are still running. So I'm actually going to probably jump ahead to something we're going to talk about a little bit later. But just as a like rule of thumb or guidance, how a lot of people think that they want to wait a long period of time, that they're unable to do a lot of things before they start getting assistance. Give me guidance as far as, if I have a long-term care policy, is there a kind of right window to trigger when I start my benefits?
So as soon as you're qualified for care, one of the things that I think is misunderstood the most is the elimination and a waiting period. So there's two different things. There's an elimination period and a waiting period. And oftentimes, let's say that I go to the doctor and they certify that I'm unable to perform the 2 of 6 ADLs, but I'm nervous of outliving my money that I have in long-term care. So I don't want to turn it on right now. Couple of things that happen with that I think aren't, I think are misnomers. Number one is that if you're paying somebody to come into your home once or twice a week, it's not a bad place to start. If you have family members that are needing care, you've probably, or have needed care, you've probably noticed that just having someone in the house is a pretty big disruptor to them, no matter what. So starting care and getting them used to having someone in there caring for them, I think, is extremely important, regardless of how long the care might last. We, of course, don't want to run out of long-term care money, but there is something to be said about starting that care and starting that process. It really sets a different trajectory on their happiness through a long-term care claim process, not just the money side. Because if we end up getting into Medicaid facilities, those people do a great job helping people through their care. The biggest problem, aside from the difference between a nice assisted living facility and maybe a not quite as nice Medicaid facility, is that going from no one has ever helped me with my things except for my family, to now I'm in a facility that doesn't look nice and I have strangers touching my stuff. So starting that claim process, regardless of the money, I think is important to just start that care at home. You may have a family member at home caring for you for a little while, and just giving them a reprieve, a couple hours here and there, 2-3 times a week, I think is important.
That's a really good point. We do see that a lot with clients where we have caretaker burnout. So the thought is we want to provide as much care as possible for our loved one and continue to do it ourselves to preserve either some of our assets or our long-term care benefits for the future. But more and more, we're seeing that there's a lot of positive things that will enable us to do other services, give care longer, if we're getting, even just like you said, if it's 1 day a week or a couple of hours a week that someone's coming in to help provide assistance, then that can be really helpful.
Mm-hmm.
Yeah, perfect. So just kind of elaborate on this. Can you expand in a little bit more detail about why I'm young, I'm healthy, retirement's maybe a little bit further away, maybe my parents are a little bit closer to retirement. Why might I or they need long-term care insurance?
We've had clients across the board that had, $500 to their name and, $5 million to their name. And you'd be surprised how often people can spend through large amounts of money um, with, in particular, this type of care. So what we've seen is the most common household that probably doesn't think they need long-term care insurance, that is at the most risk of losing what I'm going to say is more than others, is those households that are somewhere between $1 million and $3 million of assets, that don't realize how fast you can burn through those assets, because the things that long-term care doesn't cover that Medicaid does, it's difficult to explain until you go through it. That if I get a cancer diagnosis, which isn't uncommon, or if I get a one of the more common ways to trigger a long-term care facility is breaking a bone, a hip, a shoulder, a rib. Usually that can be one of those triggering events that kicks off a long-term care claim. And what ends up happening is that they spend so much time, money, and effort drilling down on that problem. They've now gone through $500,000 of unreimbursable money trying to diagnose and treat something that might not be able to be treated. And if it is able to be treated, it can cause someone to go through an awful lot of money. It can divide the family pretty quickly. So we've seen situations where a long-term care claim hadn't started yet. The family member was probably able to go on claim. They ended up with a diagnosis, and they opted to do non-standard care that ended up draining more than half of their assets out. And the care didn't work. And then on top of that, the family was the one, and in this case, it was the spouse that was the one providing the care. And what ended up happening is that the one that tried the preventative care spent half their assets trying to do preventative care. They passed away. And now the spouse that has to retire had half of the assets to retire on, and they themselves had no long-term care. Well, you fast forward 10 years, now that same spouse was on claim. We actually just finished paying claim because we did end up putting them on a long-term care plan. But had they not had long-term care, they would have completely wiped out all of their money in that process. And you might not think that you're vulnerable with that kind of an asset base, but that's why I bring it up. You're vulnerable regardless of how many assets you have. It really is a question of how much you want to pass down, and how people like to think of it's only going to happen to me. And it's hard to think of how it's going to impact the ones that, if I pass away, that might be the easiest thing that happens to my family. Versus, I don't mean that to sound bad, but it might be. It's sad for sure. But the harder part then is the surviving spouse or partner that needs care. Beyond that, has less to work with. And now the family is burnt out because of everything they just went through.
I think that's a really great point. I think about it a lot with clients when we do our planning, that we're looking at the likelihood of someone having a long-term care need, whether it's your spouse, and then a game plan of how we're going to provide for the expense for that care. And so obviously insurance is a great way to leverage dollars to do that. If they're not going to have insurance in place, then we'll look and say, okay, of your assets, let's realistically talk about what we would be using to spend down to pay for this care. And depending on your health, if you have, you're having health problems and your spouse or partner continues to live for a long period of time, it can be really concerning to say, hey, we've identified this asset, but not really thinking it was going to happen early in life. Can cause some challenges when we have another partner who's going to live for a long time. So we definitely go through those scenarios and think about that. But it's really challenging to know exactly when these events may occur in anyone's life. So I see some of these numbers. As far as when we most often see them, we know that a lot of them are women, because women tend to live longer than men. There are some things that we can sort of plan for. One of those things that comes up a lot is that we know that costs will be higher. That's the one thing when we think about healthcare. Inflation is getting a lot of attention right now, but healthcare costs inflate typically at a higher rate than average inflation. So how are long-term care benefits or policies addressing the issue of rising costs for care?
That's a great question. So there are many different types of policies today that can provide a hedge toward that increasing expense. The most common hedge, I'll call it, that we see is an inflation-based rider, which really all that means is it's a markup on the policy with a designated purpose of increasing your monthly benefit or daily benefit, depending on the type of policy you have, at a specific percentage each year. There's one carrier that has a hedge that we'll call the inflation type of rider that's actually pegged toward that healthcare index. So it actually goes up by that healthcare index up to a cap each year. The most common way to combat that is to buy a 3% compounding inflation rider, because historically inflation is hovering around the 3% range. Throughout most of our lifetimes, that's been the case. And outside of buying inflation riders, there are newer policies out there today that might have a guarantee of no increase in premium, and they will often come out of the box with a higher benefit that doesn't rise unless you put one of these riders on. So I'll kind of put it in comparison. So let's say I was buying a $3,000 a month benefit at XYZ carrier of regular long-term care, and then I have one of these new policies. For the same cost of buying the traditional long-term care with inflation, I might be able to buy 30-40% more benefit, sometimes 100% more benefit, and just not add an inflation rider to it. So sometimes you can buy that level benefit and your crossover point meaning when would that a traditional policy have gained more benefit than buying that higher benefit? Typically that's going to be somewhere around the 15-year mark. Sometimes it's upwards to 20 years. It depends on the company. And then of course, if you decide to buy a policy that is maybe lower in benefit with or without the inflation, then kind of like what Lindsey had mentioned is earmarking assets that you're going to manage specifically to help offset that inflationary cost. You don't have to have every single penny covered through long-term care, but you're buying coverage whether you're paying an insurance company a premium or not. It's coming from somewhere. So it's either coming from your money or someone else's money, something you've saved for through a long-term care policy. So those are the, not very many ways, but those are the three ways we can combat it right now and what the insurance companies do for it.
So I think what's on this slide, we talked about a little bit in terms of who needs, when do I need long-term care? Is it appropriate for me? So I'm going to reshape this a little bit. I think Lindsey mentioned previously the burnout, the caregiver burnout, especially for immediate family. We could talk about personal experiences or, stories we've unfortunately heard all too often with clients and friends and family. So instead, I want to kind of reshape this a little bit and try to back in. So that statistic right off the bat is pretty staggering, that if you're 65 years old today and in good or average health, you have over a 50% chance of needing long-term care services that are going to last between 3 to 5 years. So Scott, I want to kind of kick this to you. You talked about the 3 different ways we can go about trying to cover these expenses. When in the planning process that Lindsey and I do with folks, can you talk about someone who might be listening to this webinar that we haven't worked with yet? Is there an optimal time to start sort of planning for this? When should this be a high important consideration for them?
I'm going to mention something that will help target the age range I'm about to give you right now as well. In that third paragraph, you'll see there it says it's actually a little over 3.6 million. I copied this out of a research article that's posted right down here, right underneath it. But in the year 2000, almost 37% of the claims were for people under the age of 65. So out of the 10 million claims that were filed for long-term care, 37% of them, almost 37% of them, were under the age of 65. I think that should be a little bit of an alarming stat to people, because most people think this isn't something I need until I'm 85 or 90 or 95. And that number, by the way, is getting higher and higher, not getting smaller and smaller. So the number of people that are needing care, if you fast forward into the years, the same thing's happening in the disability market. For those that are in their working years, the number of claims for people under the age of 50 are climbing tremendously. And when you look at a client that is probably making the most money they're going to make in their career, they're between ages 40 and 55. Seems like that window of time is when people climb in their income the most. And when you're buying a policy at 45 or 50, it's significantly less expensive than when you're trying to buy it right as you're getting ready to retire. Puts a lot less strain on the retirement income planning, and also provides you a lot more stability in options. So there are so many different product types out there today that when you're younger that you're buying that can end up saving you a tremendous amount of money. So my ideal window would be between 45 and 55. You seem to have the most options available to you, and for most, they're in their highest income earning years as well.
And Scott, you know what else happens? They're in some of their healthiest years, because what we see is once you cross over, and it could be 55, 60, 65, little health things start kind of popping up, and they're not necessarily major things at that moment, but they could be things that are enough for insurance to say, well, we actually feel like you're at a higher risk for needing care than this average pool that we were talking about. So we've been seeing some of those challenges too, where people say, hey, I'm getting ready to retire. I'm doing all my planning, Lindsey, I'm ready to get my long-term care in order, only to find out that for various reasons, they're not insurable. So what do people do when they're unable to qualify for long-term care?
So there's 3 main options that people have when they're unable to qualify for long-term care. There are some annuities out there that I think we talked about a little bit that provide an enhanced income if you were to have a qualifying event. A qualifying event for those types of annuities would be that you are in a care facility. So it's pretty rigid qualification, which is why there's no real qualification or underwriting for it, because an insurance company realizes that from the stats we showed before, 80% of the care is going to happen at home. So if they're in the longevity income game and you're waiting to turn on an income, and then you turn on an income and then it doubles when you go into a facility, the odds are in their favor that they're not going to have to stay on claim as long as what they might have otherwise. So you can use annuities to do that, and they can work quite well, actually. We've had several clients and family members that have used annuities to provide that kind of care. The second thing is utilizing trusts. So when trusts are an interesting thing, because if I set up a trust today and I go and claim tomorrow, the money that I put in that trust probably doesn't matter that much. But the reason I'm saying that is because most state and federal look back periods are 3 years. So I have to make it 3 years before the money that I put into a trust specifically becomes an arm's length for me legally. So then I can keep that money for legacy planning for my family. In that environment, you can create those trusts with language to have your family members provide care for you, so they can get reimbursed for providing care for you, and the trustee can pay that money out for that care they provided. So you can utilize trust that way. You just need to realize that you or a family member cannot be the trustee inside those transactions, because you're not allowed to control your own money and get those benefits of removing it from things like your Medicaid spend down. So if you're not going to buy long-term care and Medicaid is your primary option, then you need to think ahead of time, how can I remove money from my estate, essentially, so I can't affect a transaction with it. So then I can actually accelerate my ability to get on claim, because Medicaid will require you to spend down very significantly to qualify for care. And I know you're going to talk about the state of Washington's plan here in a minute, and it'll impact that claims process as well. And then the last thing that, my personal opinion, not that it matters to anybody in the call, that this kind of would be in order, last resort type of thing. But there are things such as reverse mortgages that allow you to utilize the value of your home to provide an income to you, to help offset cost of care. And for those that can't qualify, you might be able to use a reverse mortgage for something like that, that otherwise that might be your biggest asset. That's not necessarily a bad way to go, but you do lose control of that asset, and you do lose the value from that asset from a legacy planning. So that's why I personally put it as the last piece there, but it is an option that's available to you.
And I think that's things that we can address in our planning conversations. So, if you're in a circumstance where you would say either, I know from health reasons that I'm not able to qualify for long-term care, or if potentially just due to my age, I feel like it would be too cost prohibitive for me to get long-term care insurance at this time, but I want to have a game plan in case I am in a circumstance where I do have a high cost of care. We can help outline that for you. And I think that's something that is really important. And even in these conversations, I think when Scott says Medicaid, people are like, oh, I don't want to be in a Medicaid facility. A lot of long-term care facilities will allow you to stay there and be on Medicaid if you have paid for a certain number of years. So for instance, I paid a full 3 years for care. They're not going to kick me out after that 3 years if I'm now entering, a stage of life where Medicaid is the only source of resources that I have. So there's a spectrum of considerations to be looking at, and happy to kind of talk through those with you. As I said, I know it's things that are kind of always in the back of people's minds when we start to talk about this topic.
So getting down to brass tacks a little bit in terms of premiums, what do premiums cost? How does it pay out? How does that work? How do you coordinate with the care facility? We talked about possible inflation protection within that. How often should we expect premiums to increase?
That is a great question. And I know that for many who are on long-term care now, the industry didn't get it right when they originally priced out long-term care policies. The insurance industry is based on how many people might be on claim. And one of the things they put in there is a lapse ratio, meaning expecting a certain amount of people to not keep their policy. Well, in the long-term care world, too many people kept their policy, which is a good thing because that means that the care, the money that's provided from care was really valuable to people. The bad thing is that it causes premiums to go up pretty dramatically. The things that are going to impact the cost of your policy the most, when they're setting the original premium, though, is your age at the time of purchase. So the younger you are, the less expensive the long-term care insurance is. The type of policy makes a big difference. There are policies today that guarantee that there's never going to be a price change. Now, you could imagine that if I'm going to give you that kind of a guarantee, I might not charge as low a rate as someone else that's not going to give you that guarantee. That might not always be the case depending on your age, but you could expect there might be a little bit of a premium difference depending on how old you are when you decide to buy it. And then, of course, your health, which I don't know that I put down in here, but your health makes a big difference. And then the amount of coverage that you want makes a very big difference. So if I'm looking at the average cost of claim, yeah, so in Washington, the average cost of claim is around $6,700 a month. With a 3% inflation rider, that cost of long-term care coverage is actually almost identical to the amount of care that's provided. So the cost is around $6,700 a year for the monthly care that it provides. So that's a year. So 67, 69 in home health care is what you see at the top of the image you're seeing here. And then if you go down to the assisted living facility, we're $6,750 in in-home care. We're not even approaching the semi-private or private nursing home facilities, which are $9,900. But again, 80% of care happens at home. So we're targeting those benefit periods. If I'm looking at that same cost of care, then I'm about $3,100 without inflation. Oh, and forgive me. I'm actually quoting you. If you go to the next slide, Andrew, I think this shows it. Yeah, right there. So I am showing the $9,900 in monthly benefit with that. So it's $6,700 per year with a 3% inflation rider and $3,180 per year if I choose not to have inflation. So you can see how much inflation plays into the cost of the long-term care benefit. That's just one carrier that we looked at. There are multiple different carriers and multiple different features that you can choose to move around to make those rates different from what we're seeing here. They're also going to vary depending on whether you're doing different types of policies. So if you go to the next slide, Andrew, I think that one shows the different types of policies in place as well. So in that realm of how much does it cost, we mentioned annuities as available for long-term care. This particular type of annuity is not designed for you to take income, though you could. It's designed for long-term care. So what we looked at is what would it take to provide $10,000 a month in benefit for long-term care, and how long does the policy last with its base set of parameters? These have no inflation in them. So in those other product types, if I were looking at an annuity that was designed for long-term care, one of the benefits of that annuity today is I'm going to probably get north of a 5%, probably almost a 6% fixed interest rate on that annuity for keeping it there. And if I were to go on claim, that annuity is going to pay $10,417 per month for a 72-month period. That's not a bad deal. Very little underwriting in those products, but it's not designed to provide income now. The reason I'm saying that is that if you remember when we talked about annuities earlier, Lindsay, those annuities were not long-term care specific. Those were the what if I can't qualify type of annuities. So I just wanted to differentiate that one a little bit and it confused people. For those on the call that have heard about life insurance that has long-term care on it, we just looked at one carrier for each of these different rates. Lindsey has access to pretty much every carrier on the market that can provide you long-term care policies. In this particular one, the premium, depending on your health, is somewhere between $8,000 and $10,000 a year. And the benefit will last for 50 months. And the monthly benefit that it would pay out is $10,000. And for those of you who don't know or have heard this term asset-based long-term care, asset-based long-term care is just an industry jargon for saying you're going to take some money that you have now and earmark it for long-term care. That's all they're saying. Don't let it confuse you. Lindsey can help you understand how that impacts your retirement plan and strategy. That asset-based is really just saying, we're going to take this much money and earmark it for long-term care. So in that particular policy, it has a death benefit tied to it as well. That's just a little bit greater than the premium that you put in. You get a $10,000 a month benefit on that one. And then since it has an option to pay annually versus paying all in a lump sum, you can pay $94.43 annually for that same product without having to have a large lump sum to pay in. One of the benefits on all four of these products that we're seeing here is that there's a guarantee for those costs never to rise. Those products do not have a built-in mechanism for your premium to change inside it. The last thing I'll point out, and then I'll have you pick up Andrew or you, Lindsey, is you'll see in the benefit type column, we're showing reimbursement or indemnity. Just so I don't breeze over that, reimbursement is simply, I need to pay for my care first, then I submit my receipts, and they're going to reimburse me for qualified care. Indemnity means I still have to qualify for my claim, but they're just going to send me a check every month for $10,000. I can use it however I want, including letting it sit in a managed account. So to Lindsey's point, when is the right time to turn on care? If I had one of those indemnity types of policies, one of the things you might be able to do is with working with Lindsey is you could go ahead and turn on access to those funds right now. And anything you didn't use, Lindsey could still help manage and extend the life of that money even further for you for future care. So something to consider.
Yeah, one of the things I really like about this slide, which probably is a lot of information to be digesting, is that it really shows 4 different options of how we can get to similar monthly benefits. So, obviously it's dependent upon how much access to income you have. So if you have more income and that you could use to help pay for some of those premiums, then you would see the life with long-term care or the bottom asset base is a good solution, right? We're saying it's, $8,000 to $10,000 a year that we're plugging into a policy for a period of time. Where the top annuity option and the middle asset base are ones where they're saying, hey, we're just going to put aside a chunk of money that we're going to let be there for long-term care if we need it. And if not, we still then have that asset that will be there that would go as a death benefit to a loved one. So different from traditional long-term care policies that many of us are probably more familiar with. These are kind of different options that we can look at where we're saying, hey, it's providing more than just the long-term care benefit. There's other components to that, but also in some instances, we don't have to qualify for the long-term care. So can kind of, depending on your circumstances, there's lots of different ways that we can approach that. And then as Scott said, oh, go ahead.
Yeah, and the rates being shown real quick are for a 60-year-old. So if you are in that younger range and we get to the planning phase sooner, your rates can be significantly improved on that.
yeah, and it's really just, our role is to help educate you and help you find solutions that might fit your needs. But what I love about the long-term care space is that it's no longer sort of a one-size-fits-all. It can really be, hey, what is our ultimate objective, and how can we kind of find a solution that fits for everyone's individual circumstances. What I don't love about the long-term care space is that we still are stuck in a lot of this terminology that is industry specific. So Scott, you've touched on a few of these. You also just mentioned, the reimbursement and indemnity. So maybe we could real quick just go over some of these phrases or terms that people might see in their own policies or just hear about and wonder, what does that really mean?
So the insurance companies love acronyms as well. So everything we talk about right here, you may end up seeing as an acronym as well at some point. So if I understand how much money I need and how long I need it, those are the first two bullet points. The benefit period is how long am I going to be covered for? The benefit amount is up to what dollar amount. So for example, I'm on let's say I have that $9,900 per month benefit. That's my benefit amount. And if I'm lasting for 4 years in coverage, that's my benefit period. The confusing thing about the benefit period, there's a term that we're not showing here that I probably should have included. It's called benefit pool. And so there's a pool of money that might also sit there that I can take up to my full benefit amount for the duration that I'm expected to be on claim, or until this amount of benefit pool has been exhausted. So for instance, let's say I have the ability to take $10,000 a month in benefit, but I only take 5. Every time I don't take the extra 5,000, if I have one of those products that allows me to keep that benefit pool and keep coverage in longer and longer and longer, that'll actually extend my benefit period. The benefit period in some contracts is designed to, you have this time window to take claim. And in other contracts, you have this time window to take full claim. But if you don't take full claim, that benefit period can extend based on the pool of money that's available for your claim. That'll be something that'll be clearly seen on an illustration. But that is, I think, something that I failed to put on here for you, Lindsay, that I think is important to point out. And then elimination period. Do we have the definition slide for that one, or did I not include that? If I didn't, then that's okay. No, that's okay. So the elimination period is really just how long it takes for, once I've been determined to be on claim, how long do I need to wait until I can take my benefit? And during that elimination period, you are on the hook for paying for your own expenses. So let's say that today my doctor certifies that I can no longer do 2 680Ls. They start the process of creating a plan of care. When they create that plan of care and they certify me that I'm able, basically that's what allows me to be able to go on claim. I have to wait a 90-day period in order for the insurance company to begin the claims process. So once that 90-day process occurs, they're not paying me back for what just happened. They're now, from that 91st day, they're now taking a 30-day period. If you have a reimbursement policy, they're taking that next 30 days for you to receive care. You're keeping your receipts and you submit them to the insurance company, and typically within a couple of weeks, sometimes it can take up to 45 days, they determine what was qualified care and they reimburse you for what was spent. On an indemnity-based policy, you may still have that same exact elimination period, but rather than waiting for the money to be spent, they'll send you a check right away on the 91st day. that you can use for whatever you would like. There are some companies out there as well that will reimburse the first 90 days, but it does come out of your benefit pool. So that elimination period, I think, is an important one, because I don't think people realize that you need to have regardless of the type of plan you're on, you need to have a plan for the first 90 days of care to be able to afford the coverage that you're going to receive. And then your long-term care begins to take over. So whether you buy a long-term care policy or not, you do need to have some managed money to specific for that first 90 days of care. If you have a home health care rider on your product, oftentimes you can waive that elimination period. It costs a little bit extra, but that means that as soon as you're qualified for care, you can begin in-home care without having to wait for reimbursement or indemnity-based coverage. So that's something to pay attention to. Sometimes there are waiver of elimination period language in the illustration that should kind of draw an idea into your mind on what is that elimination for? Is it specifically for my my home-based care, or is it for my facility-based care? Reimbursement and indemnity, we already talked about. The next one is chronic and critical illness. And this is an important one, because I think the industry has done a lot of good with the creation of new products and new ways to access benefits. I also think it's become a little bit more confusing, because if you've ever had someone talk to you about chronic illness, they're great, but they don't trigger the same as long-term care. They do trigger close to it. And a chronic illness benefit, really, if I wrote the definition down right next to a long-term care benefit, the one thing that would stand out to you is I'm unable to perform the 206 ADLs, severe cognitive impairment, all that's going to look the same. But for most of the chronic care riders, there's two things that happen. One is that it needs to be a permanent condition, or two, sorry, just lost my train of thought. So it needs to be a permanent condition, or it's based on the severity of impact against my health. So, for example, let's say you'll see these riders on a life insurance policy. So if you have an agent talk to you, make sure you talk to Lindsey, because she'll make it crystal clear for you. But if you had an agent talk to you about, don't pay your long-term care policy, pay for this chronic illness benefit, if it was the type of policy that is based on the second way, where how did this claim experience impact my longevity, then you could get a big pot of money for long-term care or a very small pot of money for long-term care. And the hard part is you don't really know until the claim has occurred. So I'd be a little cautious of having people throw around chronic illness, critical illness riders to you. They're not bad. I do think that they need more explanation than what can often be given. And the critical illness side is different from all of them. Critical illness would be things like, if I'm diagnosed with severe cancer, or I have a heart attack, or I have a stroke, you have a life insurance policy that might be able to pay you a certain amount of money based on an occurrence of that happening. Neither one of those two replace a long-term care policy. They may be able to complement a long-term care policy. And in some circumstances, they can act similarly to one. We just need to pay attention to cost and impact to your plan when you're looking at those.
Thanks, Scott. It's the key to me when I'm thinking about this is that understanding your benefits. So if you are applying for a policy, whether it's long-term care or insurance, making sure we understand all of those components. And for those of you that already have these pieces in place, let's revisit them, because a lot of times what happens is, yeah, I got that 15 years ago, I haven't looked at it, so I'm not sure that I remember how these key pieces could play into my plan. And then even while there's so much terminology, they also then, Scott was talking about monthly benefits. Some of them have daily benefits. Some of them are, it's just really unique to your policy. So if you don't have clarity around existing coverage that you have and you want to revisit it to make sure you understand these components, we can definitely assist you with that. And then as Scott said, if you're considering coverage and you're just like, I'm lost in the verbiage of all of this, can someone kind of help me see things a little bit more clearly? We can review that in the middle of the process as well.
So speaking of review, thank you. Let's say someone has a policy and God forbid they have a fall, there's an incident, there's some cognitive decline that the family notices. So they know that they have a policy. Maybe they've reviewed with Lindsey and I at some point, but then procedurally or administratively, how do they go about submitting a claim? I heard you need to look for the elimination period, something about receipts, a doctor. What does that process look like?
So I think an important thing, that's an important distinguishing factor here, that the insurance industry actually has done a pretty good job of helping solve if the customer knows to go to them first to help solve it. So the insurance companies put significant resources in place to help determine if you can go on claim. Some of those services would be like concierge service for especially some of the newer products to really help verify and turn on the long-term care product for providing the claimed benefit. The first bullet point here is doctor verification of inability to perform 2 of 6 ADLs without substantial assistance. The very next bullet point is a plan of care. Most doctors did not provide a plan of care when it comes to long-term, because remember, long-term care is not medical related. It's assistive care, not medical care. So your doctor on medical care knows that you can't perform 2 of 6 CDLs and you need help, but they're not qualified to write out a plan of care. They could write you a prescription. They can write you, maybe you need crutches, maybe you need a walker, maybe you need a wheelchair. They can do that type of thing, but more and more doctors are not in the spot where they can write a plan of care, nor do they know how to write a proper plan of care for receiving long-term care benefits. If you are not in a care facility already, then this is where, to Lindsey's previous question, is how do I know when I should go on claim? This is it right here. So if your doctor has verified that you have 2 of 6, you can't perform 2 of 6 ADLs, or you have severe cognitive impairment, you really need to seek a professional. And if you have a long-term care policy, especially the newer ones that are available today, they have a concierge team at the insurance company that can help draw up a plan of care, because your doctor isn't, and no offense to your doctor, it's not a dig on your doctor, it's just not what they do. And it's an extremely important piece to the puzzle on qualifying for care. Then you have to go through the elimination period, through that plan of care period. And then depending on whether you had reimbursement or indemnity, you just need to collect your receipts along the way if you had reimbursement. So then when I get to that 91st day in the example that I gave, I need to make sure that from day 91 through day 120, that I'm collecting all of the receipts possible, because I do need to turn those in. If you have a long-term care policy with that concierge service I mentioned, then that's part of the process that they help walk you through, is how to collect those, how to submit those. That can be the clunkiest part of a claim. Once you get in the process of collecting those receipts, it becomes very easy. So the debate on reimbursement versus indemnity, I can go on either side of the debate, actually, but once you're in rhythm and on claim, having a reimbursement-based policy has not been a very big problem. It's just getting into the habit of collecting those receipts or having a facility that can work with your care coordinator and directly send those receipts on your behalf if need be.
Thanks, Scott. I think the other thing is, if you're in a situation where maybe you have a family member who, could potentially be making a claim for long-term care, so it might not be you or your spouse yet, but someone else that if it's even a question, I think it's worth a call to the provider. As Scott said, there's teams there that are there to help you make sure that you understand the consequences of beginning a claim and not just like saying, okay, great, we're going to process for you and get it going. And then, 6 months down the road, you learn something that you kind of wished that you knew before. They've really come a long way in helping you through the process and giving some guidance for your circumstances. And we're obviously available to give guidance as well. One of the things that I mentioned at the beginning of the conversation is that, we're going through this period where we're getting a lot of notifications from current providers that are saying we're raising your premiums. And as people have had these for a longer period of time, they're continuing to see premiums increase more and more. And Scott, you said at the beginning of the call that part of it was just that the way that they did their projections or expectations for how many people were going to be remaining holding these policies and really kind of figuring out what the true cost would be. They didn't do a good job of those projections. So we're kind of stuck in this situation where we have really great policies that are of tremendous value if we claim on them. And there's this whole if that kind of sticks around there. So one of the things that we wanted to just kind of, have a brief touch on, because everyone's circumstances are different, are, what do I do when I get these notifications? How should I be thinking about this? And, what to expect going forward. So as we were preparing for the call today, I shared with Scott that, I'm frustrated by these kind of mailings that happen because the insurance companies lead with big numbers. We're going to seek increasing our premiums, 300% over the next however many years. And, we'll offer you a one-time buy down of your policy. Just all these things that kind of make you feel like you should take action. And in preparation for this call, we were really both reflecting on the personal experiences that we've had, the things that we've seen from clients, and how really there is no way to kind of quantify the value of some of these policies until after the fact, right? We don't really know how much we're going to need this, but when we do need them, and when we need them for the full benefits that are available to us, they are just a tremendous asset to have. So each one of you have different circumstances, and we continue to have those conversations with you. But the thing that I would say around all of this is that we need to continue to have a high conviction around having long-term care. So believing that these benefits are going to, provide us with financial support, take away stress from other family members, really, kind of think about the full gamut of why did we get the long-term care insurance in the first place? And then how, so I was saying to Scott, I put him on the spot and I said, Scott, if you had to decide if you were going to reduce your inflation rider, reduce your daily benefit, reduce your full benefit period, like which one would you choose? And, I'll say what you said, Scott, you were like, I wouldn't reduce any of them, right? Because we believe so highly in this insurance piece of our lives. But for those of you that are getting these inquiries, please do reach out, because it's going to depend on your individual circumstances. And just like we said throughout the conversation, it's really going to depend on what other assets you have available, what your legacy goals are, what your health status is. I mean, there's a lot of factors that would go into this conversation. And our job is to help educate you about all of these options that are coming to you from insurance companies so that you can make an informed decision. So Scott, I don't know if you have anything that you'd want to add to those comments before we get to our final slide.
Yeah, I mean, I just think that if there's a choice between putting food on my table and paying my long-term care premium, of course, tough decisions may have to be made. but I do think it's one that it should be a cautious decision and you need to have someone like Lindsey that can talk through, you know, having somebody that agrees with everything you say isn't always the right thing. You need to have somebody that can take another stance and give you some things to think about. So you're not, so you're kind of going into that situation with eyes wide open. So.
And then there are some, you know, kind of guidelines or rails as far as how often premiums can be increased. There's state regulations. There are, you know, there are other things, because I think the big concerns that individuals have are just, you know, if it's increasing this rapidly now, what's going to happen over the rest of my lifetime? So I do think there is long-term considerations to make around, you know, the premium side of it, but also really want to think about that benefit side as well. I know that we've gone just over, but we do want to finish on our slide that's specific to a recent legislation change in Washington State. So Andrew, I'm going to pass that over to you.
That sounds great. Thank you. So, yep, we'll keep this short. The takeaway is that in 2019, Governor Inslee signed into law what's called the Washington CARES Act. Premiums for this started coming out of our paychecks this past July 1st, thereabouts. Basically 58 cents about every $100 that an employee in Washington State, I almost said Washington State employee, but that's not correct. If you live and work in Washington State, 58 cents of every $100 you make goes into this basically insurance pool that's really the first in the nation to do this. It's a state-sponsored long-term care insurance program. We talked a couple slides ago that the average cost in 2021 was somewhere around $6,700 a month for these long-term care needs. With that said, the lifetime maximum benefit for the Washington State program is $36,500. The good news is that is indexed to inflation, but the bad news is that won't even cover 6 months of insurance. So there are pros and cons to this, but we have a blog post about it that we'll be sure to send out. But it's first of its kind in the nation. There are, I think, 19 other states that are looking at doing something like this. There are a number of pros and cons. It's not portable. So if you're like my parents, you decide to move to Arizona after contributing for 10 years, too bad. You don't get to keep any of the premiums you paid. Again, as other states possibly start to adapt that might change a little bit. But it's something. There are, again, plenty of pros and cons and a lot of talking heads on either side of the aisle. But this is something that we wanted to make everyone aware of. Benefits will start being paid out in 2026. So basically for the first 3 years, all of us who are working are generously contributing into this program. And time will tell what other states adopt, but this is something. This is a drop in the bucket, but it's a drop. Scott, I don't know if there's anything else with your expertise you want to add to that. I'll let you take it over.
I'm a firm believer in doing what you can to control your outcomes. And it's nice to have ancillary benefits, but I would just encourage everybody to do the right plan you can with Lindsey and her team to help control the outcomes that you want. You'll have the happiest retirement, and God forbid you need a long-term care claim, you'll have the happiest long-term care claim experience you could. So keep positive and see what you can do to control your future through proper planning. It's the best advice I could give after that. So.
Well, Scott, thank you so much for your time and all that you've shared. We will, kind of continue to have these conversations with clients. And I would really just, if you're on this call, I'm sure you have questions either about your policy, or if you don't have a policy, just that open-ended question mark of what would happen if this were, to occur in my circumstances. So please reach out to Andrew, myself, or another member of the team, and we can answer any of the questions that are top of mind for you, or continue to review them together through our meetings throughout the year. But thank you all for joining today. And this is always a big topic that we have lots of questions about. So we'll be sure to continue to provide more information and resources to you, as we work together, but also in forums like this where we can bring in an outside expert as well. So Scott, thank you so much for your knowledge. Andrew, thank you for helping to facilitate. And with that, I'll wish everyone a great afternoon and hope that you have a wonderful Thanksgiving.